You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. The problem of affordable housing in this country is likely going to be solved through a mix of public and private partnerships. Probably easier said than done, and I think few people understand that more than my guest today, Pete Carroll from CoreLogic. He oversees CoreLogic's industry and public sector engagement programs. Prior to joining CoreLogic, he held positions at Quicken Loans, Wells Fargo, and the Consumer Financial Protection Bureau. So he's got a wealth of knowledge. Welcome, Pete.
Hi, Deidre. Thanks so much for having me today. I appreciate being here.
Well, I've been looking forward to talking to you because I think that you think a lot about affordable housing the same way I do, but I feel like you have a better understanding perhaps of the governmental component. What are you thinking about the Build Back Better plan as it's been evolving, and what should investors and consumers be keeping in mind?
So this is such an important topic because there's just a tremendous amount of subsidy in aid for affordable home ownership that's hanging in the balance here. It's worth congratulating Congress on passing the infrastructure bill, a bipartisan bill that has provided a tremendous amount of assistance for climate change, which has effects on housing. But it is the Build Back Better plan, also known as the Budget Reconciliation Bill, that has tremendous amount of subsidy for affordable housing. It's really a status situation. The House is in the midst of iterating drafts of the bill. So anything I mention about this bill is subject to change as it goes through iterations. And part of that is a function of BTIG research. Isaac Boltanski is somebody I follow closely. He's all over these updates on this bill, among many other issues. And he projects that the bill will sign into law before the end of the year. But he also notes that we had a price tag of in around the $3 trillion range that came down to about $1.5 trillion. Isaac seems to be pegging the bill at, when it becomes law, coming in over $1 trillion, with roughly $150 billion for affordable and accessible housing. That's a big number. So, maybe not what everybody wanted, but $150 billion to support affordable and accessible housing, at least from my perspective, is very welcome. The last draft that I've seen, there may be others, was from November 5th. And, it had some notable figures in it that it's as designed will help, at least this 11.5 draft, will help 294,000 households afford their rent. And it will build, upgrade, and retrofit over 1.8 million affordable housing units. And I think, if we've not spoken before on this, I've mentioned in other series we've done at CoreLogic that, we're looking at an affordable housing gap of about 4.35 million units overall. So 1.8 million is a really big dent in that problem, especially if it's addressing some of the affordable home ownership concerns for low to moderate income households, which is where equity in housing is a major issue. And of course, if that's stimulative and that gets the market, if that stimulates the market and it stimulates new development, that could take on a life of its own and fill that gap. So it's very encouraging. And especially the components of the bill that are designed to help close the racial wealth gap and make, as it's described in the bill, the first ever national investments in home ownership for first generation home buyers. So a lot of really exciting elements of it. I mean, just there's so much to the bill. We could spend the whole podcast going through it, but I think the major elements to touch on, we tend to segment just for discussion purposes, economically disadvantaged homeowners who are extremely low income, which is 30% of area median income, or lower, very low income, which is 30 to 50% AMI, area median income, low income, that extremely low income, very low income is about 2.6 million units of that 4.35. So a big chunk of that, roughly half. And then the low to moderate income, which is 50 to 80% AMI and 80 to 120% AMI, respectively, for low and moderate income, that's about 1.3 million units. And then economically advantaged families, which is above 120 AMI, there's a gap of 650,000 units there. So I guess I mentioned that because it's kind of helpful to graft some of the investments onto that rubric. So just looking at that, we see in that 2.6 million unit gap, 25 billion going to tenant-based rental assistance, that's to fund housing vouchers and other support services, 65 billion to repair public housing and preserving and improving over 500,000 public housing units, and that's making them safer and healthier. Affordable housing production, so that's 25 billion to fund the construction, purchase, and rehab of affordable homes for low-income people. So that's now moving from the economically disadvantaged, extremely very low income into the low income. So tax credits designed to stimulate the supply of new homes, 25 billion for that. And then another 10 billion invested in the home program, which has demonstrated some success to create and preserve nearly 175,000 homes for low-income renters and homeowners, and as well as assistance for 46,000 prospective and current homeowners to purchase or repair their homes. And then I think I'll also mention 15 billion to construct or preserve 141,000 rental housing units for the lowest income families. So a mix in there of the economically disadvantaged and the low to moderate income. And then notably 10 billion for first generation home buyer down payment, closing cost, or interest rate buy down assistance, which is huge. That can help an estimated 273,000 individuals become homeowners and begin building wealth. So that's unique in that it can help with down payment, it can help with closing cost, it can help with buying down an interest rate. And then, and that interest rate buy down is interesting because that is a way to opt to potentially, instead of having a 30-year mortgage, maybe get a 20-year mortgage that costs the same as it would otherwise for a 30-year mortgage, so you can accumulate equity faster in that home. I could go on and on. There's so many programs in here. But probably the last one worth mentioning is the National Flood Insurance Program, debt forgiveness. There's a provision to forgive 20.5 billion in debt that the NFIP is carrying. And what this would do is free up those funds for improving the mapping, claims management, and provide other investments to strengthen the resilience of the NFIP program going forward. So very productive use of funds there.
Excellent. Yeah, I think on the national level, some big changes. Also changes at the state level. California just made some changes with regarding zoning. We've seen some upzoning before in other cities. It really seems to be something that hasn't quite fully been tested yet in terms of changing housing. But what are you thinking about it?
Yeah, it's funny. Another element of Build Back Better that I held off until this question was that there's 1.75 billion in the Build Back Better plan for competitive grants to states and local government, as well as Indian tribes, to incentivize the elimination of exclusionary restrictive zoning and land uses to advance fair housing and support the creation of affordable housing across the country. That's significant, 1.75 billion in grants. So that's essentially, hey, there's grant money here, significant portion of grant money, and it's designed to help prevent, to encourage or incentivize state and local governments to modify any zoning policies. The extent to which upzoning, so that would be, an example of upzoning, right? So common example is if you've got a wide swath of buildable land in a metropolitan area, and it's currently zoned to be single family detached only, so one unit single family detached, the traditional single family home, allowing more units to be built on that land, whether it's still single family homes that are 2, 3, or 4 units like duplex, triplex, quadplex, townhomes, row homes that generate more units per square foot, or multifamily housing. I think a city can choose any mix, but I think the idea is to move beyond single-family detached one unit, and I think the term I often hear is gentle density, gently increasing the density, so that it's not just completely changing the landscape of a community, but it is providing for more housing. The extent to which upzoning will change the housing situation, I think it varies. I think in some cities where land is scarce and expensive, that could have a tremendous effect. Especially if municipalities follow through and actually want to make those changes and capture some of that grant money. In other cities where we've done work, land is land is abundant and not expensive. So there are already fairly flexible zoning policies in place. So I think it will definitely have a positive effect, just like anything else, not a panacea. It requires many, many different arrows in the quiver, so to speak.
Yeah, absolutely. So you've spent your whole career studying housing finance. It seems like some things are changing, maybe some things are slower to change. What are you seeing that is changing that makes you optimistic?
Well, I think there's a tremendous amount changing. I think it's actually spectacular. So, there's a few things I'd point to. And this is non-exhaustive, incidentally. I think just given that we have limited time, FHFA put out a request for information on a requirement they are planning to put in place for the GSEs, where they want Fannie Mae and Freddie Mac to create annual equity plans. So annual strategic plans designed to reduce the homeownership gap across race and ethnicity. In other words, improve Black, Latinx, Asian, other race, ethnicity homeownership rates. And these are annually submitted plans that are 5-year plans. And the request for information was quite detailed, and it really ran the gamut of both demand-related issues, such as what are some of the affordable mortgage lending issues, or other issues, kind of structural issues that are impediments to prospective homeowners obtaining affordable, responsibly underwritten mortgage financing. But then, notably, it also included many elements of how the GSEs could assist on the supply side, which is not their traditional domain, of course. But I just thought that was remarkable that FHFA would take this step in a positive way. I think it's remarkable because I think there is much that FHFA and the GSEs can do and are already doing and can continue to do to help solve this problem, particularly in conjunction with an investment like Build Back Better. So that's one element I'd point to. Another would be loss mitigation at FHA. I think I'm going to touch on this more later, but there's a lot of emphasis being put into what to do about the 1 million remaining homeowners from CARES Act who have taken out CARES Act forbearance, but have yet to exit CARES Act forbearance. And it really requires some creative thinking because FHA has limitations to what it can do with respect to loan modifications and other loss mitigation options. And there's some really creative thought and policy thinking going into different loss mitigation solutions that can help the 1 million homeowners. It's worth noting that 6 million, at its peak, 6 million homeowners were in CARES Act forbearance. And we're down to 1 million. So we've come a long way, but we still have a ways to go. And just seeing a lot of intense effort on how we can get this, the remaining million homeowners through this process so that they can retain their homes, hopefully, and we can put this crisis behind us and pick back up where we left off. I mean, it would just be really a spectacular policy initiative spanning 2 administrations, which is exciting. So those are the 2 immediate things that come to mind. The other is, of course, this intense focus on climate-related risks to the financial system, which includes housing and housing finance. And we've seen really robust, thoughtful reports put out from the National Economic Council that touches on the HUD, federally backed mortgage lending programs, FHA, VA, USDA and Ginnie Mae, recommendations for how they can shore up their policies, procedures, risk management protocols, disclosures to address climate-related risks, and then a report from the Financial Stability Oversight Council, FSOC, at Treasury, which is obviously the collective of all the prudential, market, and consumer regulators. A very substantial report put out with policy recommendations for how to start building the competencies, data infrastructure, and then policies to combat a range of policy issues, ranging from consumer disclosure to climate audits to try to get a baseline on how climate-related risk is affecting mortgage assets and related property assets across, and other assets, of course, other infrastructure under the purview of these regulators, all the way through to investor disclosures. So a broad range of policy prescriptions coming out of that FSOC response to the executive order on climate-related risk to the financial system.
Excellent. Well, we've talked about a couple of ways that trying to solve that problem of speeding up housing development. When I look at it, it seems like the approval process takes a long time. There's questions of incentivizing developers to build, and then also trying to figure out ways to speed up the development process. What else do you think is a factor in getting to that critical mass of housing that's so needed right now?
So I think you've hit on them. I mean, we definitely, at least my perspective is, I've spent most of my career in housing finance, and I'm not a housing development expert by any stretch, but I've spent the last 3 years to kind of deep diving into this topic, and my housing finance background hasn't hurt in that regard. But I've really tried to listen to the experts, and these are the folks on the ground at the city level, municipal level, and county level. And these are folks who are in the trenches dealing with these issues day in and day out. I mean, we're talking about city departments that provide the zoning and land use policies. We're talking about realtors. We're talking about home builders, community development corporations, mortgage lenders, construction investors, neighborhood associations, city and county council members. There are so many stakeholders involved. When we really get down to it, it's we can create lots of subsidies to try to stimulate housing, but at the magic happens at the local level, and it is a really complex process of trying to align the views, which are not inherently disparate, but you've got different stakeholders with different missions and different objectives, who have different considerations about what type of housing to build and where to build it. And the real trick is, how do you get those views into alignment in an efficient way so that when a home builder, for-profit or not-for-profit, submits a plan to the city or county for permitting or approval, that it's smooth sailing. Because there's really nothing inherent about how cities and counties approve or permit, in my view, or at least from what I've observed, that is problematic. It's more that those processes can get bogged down if there's stakeholder disagreement. So to the extent there are tools and frameworks to help home builders and help cities and help investors, try to create evidence-based thinking and planning around what types of homes and housing to build and where to build it, and to socialize that thinking, that evidence-based thinking, in an efficient manner, we really think that can go a long way to speeding up the development cycle. Because if you just think about it, if you go from a system where there's not a lot of evidence-based thinking, and just because the data's not there, and the evidence base isn't there, and there aren't really mechanisms to collaborate efficiently, you could get caught into loops of approvals and permitting cycles, right? And it's not the process itself that's a problem. It's the lack of communication, collaboration, and trust amongst the stakeholders that's the problem. So, what could take months or years, you could just completely slash that cycle time. And if you could slash that cycle time, you could really speed up the cycle time for a home builder to go from a concept for what they want to build and where they want to build it, to actually getting their shovel into dirt much quicker. And if they can do that much quicker, they can expand their capacity to build more homes in a given year and create new housing starts in a given year. And that is, that is not a silver bullet problem or solution. That is a in the trenches, roll up the sleeves and get it done kind of solution. And if you can do it, what's exciting is, the analogy we use is, what could be a dirt road today for a home builder, trying to travel across a dirt road to get to that approval so they can build their development. If we could turn that into a superhighway, right? All of a sudden, all these subsidies that are flowing, this 150 billion of subsidies, they've got somewhere to go, right? I mean, it's like you've got all these, you've got these freight, these trucks and cars of subsidy that are like just dying to get across this road, and like we need to create the superhighway so these subsidies have somewhere to deploy and actually provide the accretive value to expand the capacity for these home builders to build more. So it really is about trying to get this sorted out at the local level and create the preconditions so that subsidies can do what they do well, which is accelerate, right? Capital accelerates.
Well, you mentioned something interesting there, local versus, state and other things like that. We saw that so much with the eviction moratoriums. It was just a hash of different decisions that weren't really well aligned. What did you take away from that whole experience?
I think I have maybe a slightly different view on this, which is that, the COVID-19 pandemic was, it just caught the entire world by surprise, of course. And I like to reflect on, those of us who were around for the 2008 financial crisis, that was a mess. We had scores of investors with disparate pooling and servicing agreements, which meant they all had their different policies for what they do for homeowners who have a hard time repaying their mortgage, right? So there were limitations on the types of loan modifications that could be offered to a distressed homeowner, pre-foreclosure alternatives, post-foreclosure alternatives to provide assistance. There wasn't any level of standardization. There wasn't a regulatory regime in place until the Dodd-Frank Act was passed and the CFPB passed a rule in January of 2013 to create some process and standards around loss mitigation. I think about where we were, and now I think about where we are, particularly in light of having a crisis. And we've come so far. We've got, in very short order, the GSEs, FHA, VA, and rural housing marshaled a response and created not only, and part of this is that they had started building competencies in the wake of natural disasters. There were the hurricanes of 2017 and 2018 that necessitated policy response. So there was already a good baseline of work done on this. But by the time COVID hit, the federally backed mortgage lending programs were in a position to be able to take all of the great work they had done standardizing loss mitigation programs, loan modifications, and other programs that they had created as responses to natural disasters like hurricanes, and then enhance them for this unprecedented event around COVID-19. So, in no time, Congress had to come up with a solution in the CARES Act, which gave everybody a pause button on their mortgage payment for a year. And then there had to be a hustle to figure out how to make sure servicers could float that money without becoming insolvent. And regulatory agency heads did a great job making sure that servicers stayed afloat during that period by modifying policies. And then likewise, the federally backed mortgage lending programs, Fannie, Freddie, FHA, VA, rural housing, Ginnie, came up with novel loss mitigation solutions that really position homeowners for success. And the proof's in the pudding, where we've seen now the results. And I don't have all of the exact numbers on me, but we are looking at the vast majority of homeowners of the 5 of the 6 million that have exited so far have exited successfully, either just refinancing or paying off their mortgage in some way, or reinstating their mortgage rather by paying their arrearages, or moving into a deferral program that lets them just take those payments and put them to the end of the mortgage. So point being, I thought a very impressive response was marshaled. there are things that could be done better. I mean, the eviction moratorium was on the one hand, on the other hand, right? I mean, a very double-edged sword around that issue that doesn't have an easy solution to it. And of course, there's, the recent relief in the Homeownership Assistance Fund, the HAP program, which is being distributed through the states. And there we're seeing the challenge of something as thorny as allocating money for loss mitigation. I think the idea was to kind of frame it on the hardest hit funds program that was created in the wake of the financial crisis. But I think what we're learning is that when you get down to the nitty gritty of loan level treatment for individual borrowers who are in distress, it's a much more complicated calculus. So I think we're learning lessons from that will apply next time. But overall, I think the federal government and states and localities have done actually a very, very good job dealing with what is a very, very difficult situation.
Thank you. Let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Have you realized capital gains this year? You can receive a tax break on your capital gains if you reinvest them in the Origin QOZ Fund 2, a private real estate investment that will be a diversified portfolio of ground-up multifamily developments. Some examples of assets that can be sold and the proceeds reinvested in the QOZ Fund are stocks, real estate, a private business, cryptocurrencies, and art. If you reinvest your capital gains in the QOZ fund, you can receive major tax benefits. In fact, an investment in the Origins QOZ fund can even boost your after-tax real estate returns by more than 75% as compared to a non-QOZ investment in similar properties. QOZ Fund 2 is offered by Origin Investments, a top decile fund manager who has executed more than $2.6 billion of real estate deals. Their first QOZ fund closed in July of 2021 after raising more than $265 million from over 800 investors. Go to origininvestments.com/millionacres to learn more about tax benefits of the QOZ program and to download your fund overview today.
I'm back with Pete Carroll of CoreLogic, and we're talking about housing affordability. So one of the things that we've seen is that the rates of homeownership vary so much across different neighborhoods. I know there's a lot of plans to try to fix that, but at a fundamental level, how do we create more equitable paths to homeownership?
Again, I'd point to the FHFA equity plan, RFI. I think it's something that, to the extent your listeners are interested in these types of issues, I think it really lays out a number of objectives that really cover the spectrum of supply and demand issues. But I won't rehash all of them here. But what I will say is that I think that, one of the kind of drum beats we like to focus on is that we're talking about when we talk about this affordable housing crisis, and we talk about creating equitable paths to home ownership, we're talking about a very complex intersection of supply and demand related issues in housing. So by supply related issues, I mean, we need to add more housing stock, and we need to figure out what type of housing stock to build and where to build it. Which we talked about in our first segment, that there's lots of challenges and barriers. You've got a low interest rate environment that's driven up home prices. You've got the kind of ever increasing cost of land, lumber, labor, equipment, materials. Just the cost to build keeps going up. We've got lots of challenges. We got zoning policies that could be restrictive in terms of what you can build and where you can build it. And then you get this whole challenge of how do you align sometimes disparate objectives across stakeholders that a home builder needs to have in alignment if they want to see a smooth sailing permitting and approval process. So lots of challenges. And, that's the supply side. And on the demand side, it's equally as complex, where you have to make sure, if the goal is to try to get low to moderate income families that are disproportionately people of color into home ownership, so they can start generating wealth, creating, sharing in the wealth generation opportunities that housing over and over again demonstrates it provides. You need to have affordable, responsibly underwritten mortgage loans that are available to them. And oftentimes these supply challenges and demand challenges intersect with one another. And a good example would be appraisal gaps. That's one I point to a lot, where if there's a community, oftentimes, like in the work we do, we work with, say, community development corporations, nonprofit home builders, and they have a vision for affordable home ownership developments they want to create, say, in a suburb of a city. And they, are able to find the land, they're able to kind of create their designs, they're able to get everything lined up. But the challenge is that in that neighborhood, because that's going to be either new construction or rehabilitation of existing structures that are there that are just, maybe old and either a combination of outdated or just not quite, up to code and need to be, enhanced. Either way, you're coming out with a new home that is going to have a higher value than the other homes in the neighborhood that have not had that investment. And so that's, in the world of appraisal called market comparable properties, right? When you go to underwrite a mortgage for a homeowner, you want to, the mortgage lender wants to have some confidence that the sales price for the home is reflecting the actual underlying value of the home. And it's a real challenge in communities that you're trying to what we call tip, right? In one city we work in Memphis, there's a standard that's used actually across community development corporations called a tipping point methodology, which is when they pick a census block group or neighborhood that they want to invest in for home ownership. For home ownership developments, they have a methodology they apply that helps guide them to, hey, this is a neighborhood where some incremental investment in fixing up homes could actually be the difference maker to tip that neighborhood from tip it into a more accretive economic cycle, actually, start the ball rolling in a positive direction in terms of its economic development. And it's a real calibration effort because you want to tip that neighborhood in a positive way for economic growth, but you don't want to do it to such a degree that it heats up so fast that it starts displacing existing residents who are there. And it's the term gentrification for that, right? So a lot of really heavy thought goes into which neighborhood should be candidates for this investment, and obviously subsidies are implicated by that. Subsidies have the same concern, and the challenge here is to first find those neighborhoods, and then you want to build in those neighborhoods. But when you build those homes, you're going to be pricing them out at a price that's well above the other homes. So let's say they succeed and they find a neighborhood and everything kind of foots out, and they have a housing development that could price out at about $140,000, $150,000 per unit for a single family detached 1-unit property. That would be considered pretty affordable in many markets, not all, but in many MSAs across the country, that would be an affordable price point that many low to moderate income households could afford at current mortgage rates. The problem is when a mortgage lender goes to appraise that property, because there are not like comparables in that neighborhood, they may get back an appraised value of half that value. And there is also a discussion of bias, and to what degree does racial bias bear on that calculus? And it very well may. So I'll just describe it as the combination of a potential bias challenge, but then the fundamentals of the lack of market comparable properties that kind of inhibit the LMI homeowner from being able to purchase those homes. So we have to solve that problem. And just one shout out I would give would be to the Tennessee Housing Development Agency, THDA, very creative state housing finance agency. They did a pilot, an appraisal gap pilot, where they kind of joined up with this tipping point methodology approach. And they said, look, if the challenge is getting market comparable properties so that we can close the gap on these appraised values, we'll provide grant funding for the initial sets of homes developed. So if there's a gap between the appraised value and the sales price, we'll cover it. And the idea is that becomes stimulative, so that if you can get past that hurdle and the low to moderate income family can obtain the mortgage, become the homeowner, you now have market comparable properties for a subsequent set of developments that occur in that neighborhood. So it's just like, I hope that, and a lot of nuance I layered in there, but it's a really good example of how you can't solve one side of the problem without solving the other side. You have to come up with creative solutions that bridge that gap, right? Adding new units is great, but if the low to moderate income homeowner can't access the mortgages to buy it, it's the sound of one hand clapping. And we need to be able to have creative solutions that bridge that gap.
So one of the things that I'm thinking a lot about is the impact of COVID-19. We saw this sort of great migration. But one of the things that I found most interesting is people moved to places like Phoenix, Miami, some of the places that are facing more severe aspects of climate change. How do we find ways to get people to move to places that might be more stable for the long haul?
So, this is a great question. And, we've done some analysis. CoreLogic has done analysis using our application database where we're able to look at mortgage applications and measure what we call net out migration and net in migration based upon those apps, where you can see apps inbound in a city or apps apps declining in a city. And it's what you might expect in the wake of the pandemic. Cities like Seattle, San Francisco, San Jose, Los Angeles, San Diego, Boston, New York, DC, actually even most of Miami, not all of Miami, but a lot of Miami, all in Chicago, saw net outflows, out migration. We've seen in migration in cities like Myrtle Beach, Jacksonville, Daytona Beach, Lakeland, Florida, Tampa, San Antonio, many cities, but the point is that, and then lots of cities across the continental U.S. And these are cities that are going to be in many peril zones, so convective storms in the Midwest, hurricanes along the coast, wildfires out in California, especially as you move inland towards areas like Reno, Tahoe, right, where we've seen inflows. So it is this challenge of, I think folks are moving and they're moving without a mindset to how climate change could be affecting the risk to their biggest asset, right? I mean, like as we've been discussing, we're trying to solve this racial equity gap in home ownership. But, I think we're of the sense that not quite enough attention is being paid to the climate risks that are posed. So I think it's very important that we start thinking about, and homeowners start having the information so that they can think about if they're going to make decisions about where they want to be living, that climate is an element of that, so that they don't find themselves in a position of making one of the biggest purchase decisions of their lives and investing in an asset such as a home just to see the value of that home evaporate on them because of a natural disaster. And so, incentivize, that's a consideration, I guess, in terms of incentive. What I might add is, that'd be an example, so making, for example, information and disclosures like a climate score, for example, accessible to a homeowner who's buying a home. That'd be a great way to incentivize growth in areas that might be more stable and not as susceptible to climate change.
Yeah, that's interesting. I think there are a couple of people or a couple of companies that are working on that. One of the things I love about CoreLogic is that you always put out these reports on the impact of fires, storms, and things like that. Wondering how investors should be thinking about that data when they see those reports come out.
I'm very glad you brought up the notion of disclosure and some companies doing disclosures for homeowners, because I think this is a very important question, and we are at the most crucial moment in time for this problem. We talked earlier about the executive order and the FSOC and NEC responses. At the end of the day, housing is such a major part of our economy, and it's going to be a major part of how we think about climate-related risks to the financial system. There'll be others, but risk to housing and mortgage lending will be a major part of it. And we have to think very carefully about how we approach this. And I know there's a great desire to jump right to the answer and say, hey, how will climate change affect these properties? I want to see this now. And of course, we all want to see this now. But what we will respectfully submit is that, we have been providing climate models to property and casualty insurance providers as part of their fundamental underwriting framework, as well as to capital markets for years now, and continue to as the basis of actually underwriting with the kind of degree of accuracy and fidelity in our models. And this is the point I'd really want to get to, is like we have a point of view on how this should be approached. And it starts with making sure that our regulators have, and that's where we think it starts, is with, it doesn't have to start here, but whether it's consumers, whether it's mortgage lenders and servicers, whether it's investors in capital markets or regulatory agencies, it starts with creating the right data analytics and modeling framework. And that framework should be one that kind of makes it easy to kind of take a look at an array of options that are available in the market. So, of course, CoreLogic has our own climate change risk models. Others do too. But one of the ways we deploy our capabilities is through a public-private partnership framework. And there's a lot of discussion around, should models be open source? Should they be commercially available? I think our view is it's not an either-or proposition, it's both. That the right platform would allow any one of these actors, and in particular a regulatory agency, given the policy focus that's going to be put to this, the ability to have a platform that can take any property level set of property level data, accurate property level data, and then append that to any third-party model through the creation of a unique identifier on properties, so that you can have easy linkages of different data sets, whether that's publicly available data sets, open source data sets, proprietary data sets, commercially available data sets, and combine them so that you can have the best intelligence available to do the modeling that needs to get done to assess these risks. So that kind of framework to us is very important, in this notion that it's not an either or, it's all of the above. And then in our mind, it's like once you have the right framework in place and the right business intelligence platform in place, it's all about getting to a reliable and accurate baseline. It's like the term we use is, where is the puck today? Like, everybody wants to know the answer, where is the puck going to be? And that's a very important question. But you can't figure out where the puck's going to be if you don't know where the puck is now. And that's the physical risk assessment. We worry that there's a little bit too much comfort that we can reliably assess physical risk to properties. And by properties, I mean single-family residential, multifamily, commercial, any other physical real property or infrastructure. You need to have very robust models that can score the risk of damage across a range of natural hazards that have the potential to be either uninsured or underinsured. CoreLogic, for example, has a composite model that is able to, at the property level, for a structure on a property, score the risk across 7 major natural hazards: hurricane, wind-based perils, storm surge, riverine flooding, earthquakes, wildfire, convective storms. We can blend all of these hazards into a single score that applies to a property that correlates to a probability of damage to that property now. So what is the probability now that we'll see damage to that property? And what is the reconstruction cost value associated with that property? And once you understand what the cost would be to reconstruct all that damage to the property based on its current risk profile, which is a backward-looking assessment based upon historical data, then you can start to model, well, okay, how does this potential risk of loss, probability of loss, translate into economic loss to, say, my mortgage portfolio or to my capital reserve, right? You can start to answer a host of questions about that pertain to financial risk stemming from climate change. What I want to say about this is that accuracy is critical here, and the technology that's being used in these scoring models is everything. And to be able to accurately and reliably assess physical risk, You, of course, need substantial property level data. You need spatial data and location data so you can know precisely what is the boundary of the parcel in question, where is the structure precisely or structures precisely in question. And then you need a technology called LiDAR, light detection and ranging, which is a 3D scanning technology. It uses eye-safe laser beams to create a 3D representation of a surveyed environment, as well as a spatial analysis. And a modeling approach using LiDAR is called digital elevation modeling. And that's where you essentially create what's called first floor elevation for a structure. And that is a really key metric to being able to assess the risk of flooding, the risk of wildfire damage because of the slope and angle of the home. And that's really all about having a reliable 3D representation of that home, so you know where that first floor is relative to the ground and relative to the sea level. And when you know that, you know if it's at a safe distance or if it's not at a safe distance. And the net of it is you have to use, in our experience as having done underwriting on this with using this as actual baseline for underwriting for the insurance industry for years. You need 1 meter resolution to be able to do this accurately in a urban, suburban, even exurban environments. Because think about how closely packed properties are. If you don't have good resolution on this information, you can't really know that you're looking at the right property. You can try to infer it, but you don't know for sure. At 1 meter, you know for sure. And the concern is there are some models that use 30-meter resolution, which is fine for a rural area where where properties aren't so kind of jammed together, and you can kind of figure that out. You can infer it fairly accurately. But we would propose that level of fidelity and resolution really is everything with the physical risk assessment, because your ability, then the next step is then and only then, once you understand that physical risk profile to a property and it's reliable and accurate, that's when you can start taking climate change models. And we would suggest the Intergovernmental Panel on Climate Change, IPCC. They have a set of models called Assessment Report 5 that was created in 2014. But in Q1 or Q2 of 2022, Assessment Report 6 will be coming out, and that's going to be a major update through 2023. It's going to look a lot different from 2014. And that gives you the ability to take different patterns of carbon emission, different assumptions and scenarios of carbon emissions, and the climate change effects associated with that are projected, and do a sensitivity analysis on top of that physical risk assessment. So this is, in our mind, very critical, that if we want to, this is the moment in time to get this right. And to get it right, you got to have the right infrastructure. You have to get that reliable physical risk assessment done with the right technology, technology that's underwriting, it is reliable enough to use in the actual underwriting of insurance and loans. And then from there, you can start to apply. And we would submit using AR6 would be the more appropriate method. We're very close to it. It's not far away. Use these up-to-date models, standardized models, to start looking at what the sensitivities are to the current physical risk profile. So then you can start to get that forward-looking view. What is the risk profile to this property look like 30 years from now, 50 years from now, and do that much more reliably. So it's kind of back to this, it's a strong statement, garbage in, garbage out. But if you make sure you have that kind of really reliable physical risk assessment, then you can start applying climate change. And it's about not jumping to the conclusions, starting and doing the work to really get that current environment nailed, so that you can then take these models that are incredible and do the sensitivities to understand what could the future profile look like for these properties.
Fascinating. I love the ways that technology is being layered in here. Well, Pete, thank you so much for your time today. Reminder to listeners, you can learn more about CoreLogic at CoreLogic.com. It's just a tremendous source for anyone looking for different types of real estate data. Like I mentioned, their reports on storm damage and fire damage are really best in the business. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in deals, offerings, or services they discussed at Million Acres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.